Welcome. I'm so glad you made it. As promised, we're going to go over the important things you need to know about long-term care. Because remember, you're going to be the savvy buyer when we're done here. And you're not going to be called by anybody trying to sell you something. You know, I forgot to introduce myself. My name's Tom Rasmussen. I'm the owner of Clear Solutions Insurance Services. So now that we've gotten that out of the way, let's get to it. You know, what is long-term care? When I mention that to people, they instantly go to nursing homes or some kind of an illness, dementia, just not a pleasant thing. But the reality of long-term care is really a life-changing event that would have devastating consequences to your spouse, your children, and believe it or not, your retirement plan. So if that is a possibility in your life, who wants to think about that, right? And then when we add the different thought process that women and men go through, well, it adds another dimension. Because men inherently have an averse to risk because it's all about protecting and providing for a man. It's in our DNA. It's the main directive. So if we have to think about risk, how are we going to do what we have to do? So when it comes to these types of discussions, it's not going to happen to me. Let's move on, right? But when it comes to women, they have a great ability to see the bigger picture. So instead of that, it's not going to happen to me point of view, they have the point of view of, I hope it's not going to happen to me. You see the difference? It's not going to happen to me. I hope it's not going to happen to me. And therein lies the challenge between men and women when it comes to evaluating the risk of long-term care. But I'm a man. I understand this. But I work out, I basically eat right. I do everything I can to prolong my life for as long as possible. But I also understand for the experiences I've had through my life with my clients and my parents, that a plan allows me to continue to be that protect and provide man that I want to be in the event that I cannot do it physically or mentally, because I never know what life's going to throw at me. And remember, life happens whether you're prepared for it or not. Okay, so the first thing that we need to kind of review is the 4 planning options. And the first one is your income. And when we're talking about your income, we have to do the math to make sure that, at least in current days prices, long-term care expense is $7,000 or more a month. And obviously, they're going to be more in the future. So if this is a consideration, you got to do the math again to make sure that you're thinking about the possible impacts of lower interest rates, market conditions. I mean, who knows? But that's an impact that's going to affect your ability to pay for care of the future. So keep that in mind when you're choosing this as your plan. Number 2, your government. That's Medicare, the VA, Medicaid / Medi-Cal, depending on what state you're in. And if you're going to depend on the government, I highly recommend, again, you do your research. Because you got to understand the conditions and the limitations that those programs have. And if you have a really strong desire in a long-term care event to stay at home, then you might just find that the government option is not going to fulfill that particular desire. The third one, that's your family. That's your spouse. That's your children. That's your children's spouses. That's your relatives. That's your friends. And the whole idea of planning your family as your option is that you got to have a conversation with them. You got to let them know that's your plan, because they might have no understanding of that. So you need to sit down and you need to go over all the scenarios, because what happens if the care that's needed goes beyond the ability to provide? What do they do then? So it's important to have those conversations, and you've covered all scenarios to make sure that the stress and the financial and the physical aspect of caregiving can be avoided or reduced as much as possible, because you've put a game plan in place. And the last option is long-term care coverage. That's traditional long-term care. That's linked benefit. That's critical illness. We're going to get into that in a much greater detail as we go along through this. But just keep in mind, if you're going to choose that as a possible way to go, that's an income stream. An income stream that provides funding for caregiving. What's so important about that? Well, think about how that affects your family. It allows your spouse or your children to supervise your care instead of having to provide your care. It provides the gift of life to your children so they don't have to put their lives on hold to be a caregiver. So that's the 4 strategies, that's the 4 options. There are only 4. But you know, if you're worried about not remembering this, don't worry. At the end of this session, I'll make available a way to get that information. Okay, so let's get into what long-term care, as far as the options are. And the first one is traditional long-term care coverage. That's what most people think of long-term care when they think of coverage. The second one is linked benefit option, which a lot of people don't even realize it exists, and quite frankly, it's been around for a while. And that consists of a life coverage bundled with a long-term care benefit. And that provides some kind of different way to think about coverage, and we'll get into that in more detail as we go through this process. The other part of a linked benefit availability as far as a vehicle is concerned is an annuity with a long-term care benefit tied to it. So that's the linked benefit options that are available above and beyond traditional. And then there's a thing called critical illness coverage that we'll also get into more detail about. But when we're talking about traditional long-term care, you need to understand first and foremost the foundations of the basics of plan design. And these are things that you're going to hear commonly as you talk to anybody about long-term care plan design. The first one is you have to define your maximum daily benefit. That's $200 a day, $50 a day, $400 a day, but that has to be the first thing that you define in your particular plan design. The second thing is, how much of a benefit period do you want? Do you want it for 2 years? Do you want it for 5 years? So you have to define that along with your maximum daily benefit. And when you have those 2 things defined, that creates what they call the reimbursement pool. Now, in some cases, there's indemnity pools out there as well. There are not a whole lot of those left anymore, so we're going to concentrate on reimbursement pools. And so you understand better what this means. If I have $200 a daily benefit maximum, and I have a 2-year benefit period, that means all I have to do is multiply $200 a day times 730 days, which is 2 years, and that equals a pool of money of $146,000 that I can draw from up to a maximum of $200 a day to pay for my long-term care. Now, the significant thing to understand about the reimbursement pool is if you don't use it, you don't lose it. It's not a matter of time. In other words, if I've had $6,000 a month, which is $200 a day times 30, available to me, but I only need $3,000 to pay for my care at this point in time, that means what I don't use of the $6,000 available to me stays in the pool and extends the time out longer. So now my 2-year coverage becomes 4 years if I'm only accessing $3,000 a month. So hopefully that makes sense. The next thing as far as a plan design is the elimination period, which really you just need to think about that as the deductible. You know when you bought your car insurance and you had a choice of $250, $500, or $1,000 deductible? Well, that's kind of what this is. But instead of a set cost amount or dollar amount, it's time. It's 30 days, 60 days, 90 days. So what you're basically telling the insurance company that if I want a 90-day elimination, that means if I go on claim, that I'm going to pay for the first 90 days out of my pocket. Now, that does reduce premium costs, but it also creates an incredible impact of out-of-pocket expense. Because think about it. If just today's numbers of $6,000 a month or $7,000 a month, if I go 90 days, I literally would have to pay $18,000, $20,000 out of my own pocket before my coverage is going to kick in and start paying me any benefits. So I really recommend look at the long-term impact of that and consider a lower elimination period if you're looking to put that in your plan design. The last thing you need to consider as far as a base component is inflation riders. And that's something that you really need to spend a great deal of time on understanding the significance of inflation rider. But an inflation rider allows you to put a component within your policy that expands or increases your benefit every year by whatever percentage you put on there, whether it's 3%, 5%, 2%. Companies have a lot of different choices, so you need to look at that. But that's the other thing you have to consider, whether to put one on or not. And we'll get into details of that as well. So that's your basic plan design. But I also get asked, well, great, Tom, that's wonderful, but how do I get access to the funding? How do I trigger benefits? And the good news is the federal government came along back in 97, 98 and set the standard for all benefit triggers for all long-term care policies. And they're basically one of two things. The first thing is what we call the activities of daily living, and there's 6 of them. And if you cannot perform 2 or more of those 6 activities of daily living, then you can trigger benefits. And those activities are bathing, dressing, eating, consonance, toileting, and transferring, which is like getting out of a bed to a chair. And those have to be in a position where you cannot perform those for longer than 90 days. Because the federal government thought, you know what, we got to define the difference between acute care, which is health care, and long-term care. So if you have a condition that's going to last in a shorter period of time than 90 days, then your health insurance is for that. But if it's going to go longer than 90 days, now you fall into long-term care. And the other trigger is you're diagnosed with a severe cognitive impairment, which is your dementia, your Alzheimer's, your Parkinson's, those things that mentally, you can't take care of yourself. So that's the basics that you need to understand when it comes to plan design. Now there's a whole slew of additional riders that you can put into a plan design. And that comes down to your desires and also what additional costs you might want to add to your overall budget. But there's a few that you need to really take a closer look at. The first one is, again, we mentioned it just recently, the inflation rider. Look at that. The elimination period rider, we talked about that. You can choose 0, 30, 60, 90 days depending on the company. One I think is very, very important to look at, which is a cash alternative rider. Let me say that again, a cash alternative rider. This is one that just a few companies have, but allows you to have cash. Now, why is that important? Because in a reimbursement policy, in order to receive a benefit, you have to hire a certified caregiver to take care of you. And if you're staying at home, that means that you need to bring somebody in that's certified to take care of you. And they provide an invoice, you pay that invoice, then you submit it to the insurance company, and they reimburse you for those costs up to your maximum. So that kind of alleviates the family member taking care of you unless they're certified caregivers. But in a cash alternative benefit, they pay you cash money, and you can use it for whatever you want. And a lot of these policies have the ability to use one or the other. So that's a really important rider that you need to look at to see if it's worthy of your consideration. And then there's waiver of home elimination, which means that even if you have a 60 or 90 day elimination, if you are receiving your care at home, you don't have to satisfy your elimination. You immediately start receiving benefits because you're waiving that elimination period when you're at home. There's a few others that you need to go through. You can see them on the screen right now, and we can get into the greater detail if you ever want to talk to me about these. But when it comes to couples riders, those were individual riders I spoke of earlier, you need to also look at shared care because that's a way to cut costs where you can have 2 individual policies, and if, God forbid, one exhausts their whole policy because of a caregiving situation, that they can reach in to their spouse's policy and utilize that as well. So when you go through all of these, the base plan and the traditional optional riders, You want to make sure that you choose a proper resource that can guide you through every one of these. Make sure you have a full understanding, see what your desires are and what they might not be, so that you can put together the proper plan design that fits your desires and your budget. So next, we're going to talk about linked benefit options. Now this is, again, I mentioned it earlier, is kind of one of the unknowns out there. But when people hear about it, they go, I want to know more about that. What does that mean? Well, linked benefit is kind of what the word is telling us. It's linking benefits together. So you have life insurance that's linked with a long-term care benefit. What's the significance of that? Is that, well, I always get asked, what if I have this traditional long-term care policy and I pass away and never need a day of long-term care? What happens? Well, just like you never had your home burned down or your car have an accident, you were blessed with not having to go through that event in your life. But in this case, with a linked benefit option, because it's tied to life insurance, maybe you won't have a long-term care event. We hope you don't. But more than likely, you're going to pass away at some point in time. So with this particular option, it pays no matter what. If you need long-term care, you can use your death benefit to pay for long-term care funding. If you exhaust your death benefit, depending on the plan and the product, you could even have an extra pool of money to continue to pay long-term care benefits. But if you don't have that long-term care experience, then when you pass away, you have a death benefit that will pass on to your heirs, a tax-free benefit. And also, by the way, long-term care benefits are tax-free as well. So I didn't mention that earlier, but understand that when we're talking about benefits being paid on insurance products, it's tax-free. So we talked about the life bundling with long-term care benefit. There's also an annuity option that's available that's also an annuity with a long-term care benefit. Now, why would I want that over the life? Well, life insurance is one thing, and some people say, hey, I have enough life insurance, I don't care. Or maybe they don't have anything to leave for anybody. But they do have money set aside in rainy day funds that they want to protect because they might need it someday. Well, the annuity gives you the ability to carry on an investment position, but in the event of a long-term care situation, when you have one of these types of linked benefit annuities, you can access, first of all, the value of your annuity to pay for long-term care. And if you exhaust that, there is an additional pool of extra money to pull from, basically the insurance company's pool of money that makes available to you to continue to pay for long-term care. That's the advantage of that particular product. And again, if you never need a long-term care, you still have the annuity intact, and that passes on either to your heirs upon death, or you can use it from withdrawal standpoint just like you would do any other annuity or any other investment. So those are the two things you need to understand about linked benefits. Now, one thing I really want to point out is not all linked benefits are created equal. And you have to look at the long-term care benefit, whether it's a true long-term care rider or what they call a chronic illness rider. There's a big difference between the two. They're not created equal. And I suggest that you find somebody that understands those two differences to explain them to you before you go out there and get involved with the product with a chronic illness rider and you don't understand the back end results of that because it's not the same as a long-term care rider. So that's important. So we've gone over linked benefit, and again, that's where a lot of people say, I like this because if I don't use it, I don't lose it. And you know what? A little other something that you need to know about. In some cases, the life options, they also have a 100% money back guarantee. Wow, what do you think about that? What if you had rainy day funds set aside that were getting that big 0.5%, maybe 0.75%, and you just had it just in case something happened? Well, you're one of the lucky ones where you really don't even have to buy anything. You can just change addresses on that existing money, put it in a position to pay a much larger benefit than where it was from a death benefit standpoint and also a long-term care standpoint, and still have access to get it back. So again, you need to more of the details on these products, but they exist. So the last one that we need to talk about is critical illness. Critical illness, I want to make sure we're clear on this, is not a substitute or replacement for long-term care coverage. What it is, it's a secondary option. It's kind of a last chance situation because it's for those individuals that have not or are not able to get coverage because of health. Critical illness is a way to still put some coverage in place in a different type of format. And again, we would have to go in more details as far as exactly how this works, but it still gives you that last option without completely being locked out of a possibility of having funding available for a medical type of situation in your life. Here's the biggie. This is the one that everybody's always waiting for. In fact, it's usually what people want me to lead with, but you're going to see when I get done of why you can't lead with this, and that's pricing. How much does this stuff cost? And the reason you just can't throw a price out there because there's a lot of factors that go into pricing, whether it's traditional long-term care or linked benefit or even critical illness. And those factors consist of, first and foremost, the health. The health is the gatekeeper to see if you even get to go further into the doorway of at least looking at this as a possibility. So health is number one, that's a factor. Age, that's another one. Gender. Now, gender didn't used to be an issue. Well, now there's a thing called gender-based pricing that's come into the marketplace. And quite frankly, if you're in California, single females, you have an opportunity to still take advantage of non-gender-based pricing because it still exists with some companies. But if you wait too long and all the companies go to the gender-based pricing, I'm afraid females get kind of knocked. Basically, the increase is substantial to the point where it's best to take advantage of it now. And why is that? Why is gender-based pricing important from a pricing standpoint? Is because women use this product. They use it a great deal. So the companies have realized we have to price it according to based on the people that are using it, and that's females. The other issue at hand is your plan design. The benefits you're desired. I mean, we talked about all the different ways you can go with this. It's a mix and match type of scenario. So plan design will dictate what the costs are or what you can pull out and bring the cost down. Now, whether you apply as a single or a couple, the couple could be either married or significant other as far as what you're living together. That also will have significant bearing on the pricing because when you apply as a couple, there's significant reductions or discounts rather, 20, 30, 40%. So it makes a real big impact on that cost factor. So if you have somebody that you're considering this with, definitely consider applying together. And the last one is what state do you purchase it in? Because every state's not created equal. There's different products, different companies. And so that also is a factor on pricing. So you can see there's a lot of complexities to this. It's not easily just saying, oh, here's a price. So it is so important you find that resource that understands the complexities and works within your desires and guidelines to come up with a product that gives you that peace of mind but fits your budget. So I personally go with what I call the good, better, and best scenarios. So that way we can look at the different choices and figure out which one fits the pocketbook based on the plan design, whether it's good, better, or best. And quite frankly, if you're dealing with a resource that can't give you a good, better, or best scenario, or they don't even know what that means, it's probably time to look for another resource. In closing, please remember that health is what buys coverage. Underwriting is getting tighter and tighter all the time. And it's not because the insurance companies are greedy, although we could debate that, but it's really because the largest growing segment in society is people going into long-term care. And that's not going to change as we go on into the future. I mean, think about the baby boomers. So the issue at hand is when is the best time to get this? And the best time to get this is really quite simple. It's when you don't need it. I mean, you don't go out and get homeowners insurance when your house is on fire, do you? Do you run out after you've had your accident and say, it's time to get some automobile insurance? No, you get it before the event. And so in this case, it's important to look into this when you're healthy and you have the ability to apply. So you're probably wondering, why is this guy spending so much time giving me all this information? Where's the kicker? I mean, right? I mean, I would be. But I got to tell you, the reason I do this is because I have a great passion for the subject matter for a couple of reasons. I've been helping people for 30 years with the subject matter, and also, I also was the caregiver for my parents for the last 3 years of their lives. So I've been up close and personal to this, so I understand what it is to be in a long-term care situation. And ultimately, you know, if you're looking for a resource, maybe you'll consider me, because I believe in the giver's gain philosophy. And so the success that I have realized over the years is by providing an educational environment with proper guidance and the highest level of service is where I shine. And I'm hoping you'll give me the opportunity to prove that to you. So the ultimate question here that we haven't answered yet is, are you eligible? And again, I'm going to offer the ability to have a review that I can put you through a questionnaire, and we can find out, are you eligible? Not only are you eligible, but what are you eligible for? And again, I offer that for free, and you're not going to have anybody call you and try to sell you anything. So what do you got to lose? Basically, click the button, go forward, fill out the questionnaire, and then I can get back to you and let you know if you're eligible. And you know what? There's going to be some nice planning tools to accompany that as well. Thank you.